The oil market is currently very much focused on the bearish signals, with prices reflecting fears of a slowdown in China, a slowdown or recession in the US, and a recession in Europe. Global maritime trade is slowing down and freight rates are returning to more normal levels. The Eurozone and UK are now expected to enter recession later this year, while the US will suffer a mild recession in mid-2023. Before diving into the present situation, it is worth glancing back at the winter of 2021-22, during which it seemed like a small energy supplier was collapsing every week. The most notable of these collapses were Bulb, a company that provided over 1.5 million customers with their gas and electricity before ceasing to trade in late 2021 and entering into special administration on November 24th of the same year, a state of uncertainty in which it remains to this day. A key reason behind the fall of so many small energy companies was Ofgem's price cap. The mechanism, introduced by Theresa May's government in 2019, was intended to prevent consumers who stayed loyal to their energy providers from having to pay higher energy tariffs than those who frequently changed providers to secure more favorable deals. While this seems an arguably admirable attempt to eliminate the profiteering of energy companies at the expense of the average consumer, the unintended consequences of introducing the price cap are now reverberating around the market louder than ever. Welcome to Savvy Economists. Today we would be discussing the irregularities surrounding the energy market, the role it has played in the continuous dilapidation of the global economy, and what this means, especially as the world grows colder. You may not have enough energy to keep warm this winter. Before we go into the video, make sure to hit the like button, subscribe, and turn your notifications on. Oil prices have declined by around $30 a barrel since the recent peak in early June before the Fed and other central banks started aggressive interest rate hikes to fight runaway inflation. The tightening monetary policy is expected to slow economic growth, while several financial market indicators suggest that the markets expect recessions, which could slow global oil demand growth. The most closely watched major forecasters, OPEC, EIA, and the International Energy Agency, IEA, continue to expect growth in global oil demand both this year and next, with demand outpacing pre-COVID levels in 2023. Yet, the oil market is currently very much focused on the bearish signals, with prices reflecting fears of an economic slowdown in China, a recession in Europe's major economies, and a slowdown or recession in the United States. Several recent financial and trade indicators point to a slowdown, and the market is taking that as a cue for rising expectations of a recession at some point over the next few months. Despite a solid job market in the US and still a high level of economic activity, the financial markets, as seen in equity futures, point to higher chances of a major decline in the economic cycle or a recession over the next 6 months, Reuters' senior market analyst John Kemp notes. Then there is the falling open interest in oil futures, as many investors have fled the market due to high volatility, thus exacerbating that volatility as liquidity drops. In one of the most recent assessments, indicators point to a global maritime trade growth slowdown, a sign that the economic slowdown is underway and a recession in major markets could soon materialize, threatening oil demand. This week, the Drewry World Container Index fell below $5,000 per 40-foot container for the first time since April 2021, a strong signal of a return to sanity for freight rates, the provider of research and consulting services to the global maritime and shipping industry said. The composite index fell by 8% this week, the 29th consecutive weekly decrease, and has dropped by 52% when compared with the same week last year. The Eurozone and UK are now expected to enter recession later this year, while the US will suffer a mild recession in mid-2023, Fitch Ratings said this week, revising its world GDP growth forecast to 2.4% in 2022, down by 0.5 percentage points from the June forecast. Global economic growth is now expected at just 1.7% in 2023, a cut of 1 percentage point. We've had something of a perfect storm for the global economy in recent months, with the gas crisis in Europe, a sharp acceleration in interest rate hikes, and a deepening property slump in China, said Brian Colton, chief economist at Fitch. The oil market is also apprehensive of the slowdown expected from continued interest rate hikes. The Fed has more work to do in taming inflation, and the key interest rate needs to move up to above 4% by early 2023 and stay there, Cleveland Federal Reserve Bank President Loretta Mester said at the end of last month. The Fed's current target policy rate is in the 2.25% range, after 2 consecutive hikes of 75 basis points or 0.75%. OPEC, however, remains upbeat on global economic growth, saying in its latest monthly oil market report, MOMR, that growth is set to remain robust at 3.1% this year and another 3.1% next year, and a forecast suggesting that the cartel expects healthy oil demand growth despite market fears of recession. The IEA cut its global oil demand growth estimate by 110,000 BPD to 2 million BPD for 2022, as it expects China's oil demand to fall for the first time in more than 3 decades due to the snap COVID lockdowns. The IEA noted in its report this week that still resilient Russian supply could drop by 2.4 million BPD later this year and early next year when the EU embargo on Russian oil imports by sea kicks in. Supply in the short term is as uncertain as demand is, according to oil broker PVM Oil Associates. The wild card in predicting oil balance might be the supply side of the oil equation, but there is a tangible lack of consensus in foreseeing future oil demand, too. This makes forecasting close to impossible and no certainty is anticipated in the near future, PVM said. The last price cap announcement will be made for bleak news for households, and it is unfortunately a situation that is only likely to worsen. The new cap that will take effect on October 1st is only fixed until the end of the year, and another announcement will be made on November 24th regarding the limit for the period January 1st to March 31st, 2023. Predictions made by analytics firm Cornwall Insights previously suggest that the new year could bring a further raise of 31%, bringing the annual total up to the region of €4,500 per year for an average household. However, to coincide with the actual cap rise on the morning of Friday, August 26th, Cornwall Insights have updated their forecast price cap for Q1 2023 to an eye-watering €5,386 per year. It is clear that whatever the reality of the increased bills that households will face for their gas and electricity, some kind of change is needed to the domestic energy market. Indeed, some energy companies, including Scottish Power, have similarly called for an overhaul of the cap. The company's chief executive, Keith Anderson, was recently quoted in an article for the Financial Times stating that the cap should be replaced by a social tariff that would protect the most vulnerable households from significant bill increases, at least until the market stabilizes. While this could provide an imperfect solution, the concept of when the energy market will be stable is another problem entirely. Ultimately, any suggestions for long-term solutions to protect low-income households from crippling energy bills in an increasingly volatile world for oil and gas prices do not solve the immediate issue. Action to address the crisis from the government is yet to appear in a genuinely meaningful form, and though this may change, fuel poverty for millions of households across Britain is no longer a prediction, but an inevitable reality. On a determined mission to turn their back on Russian oil and gas, the European countries are simply staring into an abyss of uncertainty in the absence of reliable substitutes for the shortfall. Before the war broke out, the EU relied on Russia for over 40% of its gas supply. In Germany, the figure is said to be around 55%. Having a good sense of vulnerability of the European Union over its reliance on Russian gas, the world's largest country knows exactly what it is supposed to do to safeguard its interests. Russia, for instance, has already reduced the supply of its gas to Europe by 60%, citing maintenance issues, dealing a hammer blow to the need for the fuel in the major economies in the EU, particularly Germany. The growth forecast for Germany, the largest economy in the EU, has been reduced from 3.5% to 1.5%, raising the specter of recession. If it reaches the dreaded finale, the cascading effect will be extensive, analysts warn. In response, the EU, among a few more things, keeps saying that Russia is blackmailing Europe to hit back at the former over crippling sanctions. Trading blows by the blocs, however, does not solve a serious crisis that is in the offing, especially in the winter months ahead. Defense analysts already have warned that the war in Ukraine will last months, if not years, with Russia being ready for the long haul. In this context, the political uncertainty that stems from the conflict is going to make the energy crisis much worse than it is now, in the coming months. Even Sweden, the Scandinavian country known as a modest gas user, is taking measures for a rainy day, fearing a crisis ahead. To make matters worse, there are indications that a few more countries may be sucked into the conflict if the mutual suspicion among nations grows exponentially. The row over the Baltic enclave, Kaliningrad, between Russia and Lithuania is a case in point. When European nations are locked in an ideological battle over Russia, Asian buyers continue to go on their buying spree, grabbing Russian oil at discounted prices, with both China and India being at the forefront. Analysts believe they cash in on the opportunity to fill up petroleum reserves as well, repeating the scenario during the great oil price crash in 2020 at the peak of the COVID-19 pandemic. In short, Russia still manages to fill its coffers circumnavigating the sanctions. Neither China nor India is going to cease buying Russian oil due to the Western pressure. They already saw it through. European customers, by contrast, are going to suffer on many fronts due to rising energy costs that in turn leave the collective political leadership in a perpetual quandary in the face of extended strikes over pay hikes to meet the cost of living crises and, of course, intense inflationary pressure. This crisis can only get worse in the coming months. Unless sanity breaks out at the decision-making level, the Europeans will really struggle in the colder months ahead. If the faltering supply issues are not addressed, the overwhelming pieces of evidence imply that a serious crisis is just a few months away. Although there are new players in the supply chain of LNG, liquefied natural gas, the inevitable logistic problems are getting in the way when things are done in a rush. LNG suppliers, on the other hand, are not doing it for charity. They have to look after the interest of their investors while embarking on risky projects without knowing the end game very well. Qatar, one of the top LNG in the world, had been warning the world about its inability to be a substitute for the Russian supply of the commodity before the war broke out. It, however, appeared to have fallen on deaf ears, judging by the state of panic that we are in today. The speed at which some European nations such as Germany and Austria are turning back to coal, the dirtiest of all fossil fuels up until recently, just shows the desperation. Coal imports are rising and the operators are given the green light to switch back to coal in order to keep the power supplies uninterrupted, suspending the green ambitions for the time being. Meanwhile, oil prices fluctuated on Monday as investors considered the improved demand outlook following the easing of COVID-19 curbs in the Chinese city of Chengdu, against recession fears hitting fuel demand, amid high inflation and rising interest rates. Brent, the benchmark for two-thirds of the world's oil, was trading 1.23% lower at $90.23 a barrel at 12:39 p.m. UAE time. Meanwhile, West Texas Intermediate, the gauge that tracks U.S. crude, was down 1.53% at $83.81 a barrel. Oil prices rose in the early trade as China, the world's top importer of crude, began easing COVID-19-related movement restrictions in Chengdu. This is the capital of the southwestern Sichuan province and has a population of more than 21 million. Chengdu has been shuttered since September 1st amid a rise in the number of coronavirus infections. Authorities, however, started allowing people to move out of their homes for the first time on Monday. A mandatory COVID test requirement is in place once a week to control the spread of the pandemic. The world's second-largest economy is enforcing strict rules as part of its zero-COVID strategy. Anxiety over economic growth is the main catalyst for oil markets at the moment, and so long as there is a hawkish tone to central banks and China maintains its restrictive COVID policies, oil could be exposed to more downside, said Emirates NBD economists Khatija Haque, Edward Bell, and Daniel Richards. Key to the oil market's outlook may be top fuel importer China, where the economy slowed in July, with the factory and retail activity squeezed by Beijing's zero-COVID policy and a property crisis. Chinese refinery maintenance over the summer could explain reduced imports and may have temporarily helped depress global prices. The sell-off and the price fall really relate to China not soaking up 750,000 barrels a day of crude oil for the last month and a half for an almost 0.75% drop in global demand. You would see the price go down by 15 to 20%. So that's about right. As China eases lockdown in some provinces around the country, we may likely see new charts in the coming days if the ease of lockdowns is maintained. Also, as Europe struggles to find alternative energy sources and Russia maintains its stand in the war against Ukraine and its gas wars, forecasts are unlikely and making any predictions may not be the best at the moment. The question remains, who would win in this energy war? And how much sacrifice would be made for that to happen? It is very much likely that people would prefer to have bonfires and keep themselves warm than to pay exorbitant gas fees. Let us know what you think in the comment section. Don't forget to hit the like button, subscribe and turn on notifications. Thanks for watching.